Hi, everyone. Good afternoon, good morning. This is Jeffrey Cohen. It is May 12th, and I'm here to talk to you about inflation. We're doing a special edition, special video in between the weeklies, and I've been saving up a bunch of emails I've been sending to myself from articles. I've got a little write up I'm going to share, and I'm going to walk you through it. And so I'm going to start off with my little write up. If this is all you get out of it, then you got something out of it. But you may want to stick around because we're going to try to prove everything that we talk about with real data out there. Okay. So the first is I went to University of Chicago in 1986 to 89. Got an undergraduate degree from the economics department. D. Gale Johnson was the chairman of the department. Robert Lucas Jr. was one of my favorite teachers. He went on to win a Nobel Prize in economics, and to be honest, it's pretty darn cool. I was always amazed at having the great teachers. So they made a simple definition of inflation because we spent a lot of time talking about rational expectations and that people can't really be tricked about inflation. The challenge is that it's the future. So inflation expectations are about what's going to happen next week, next month, next year. But the definition of inflation right now is so well known, it's amazing. So I'm going to show you some things. The first is inflation is just the difference between a country's gross national product and the money supply. So that's easy. I actually did that. I remember doing this as a teenager and in college and in grad school. You just look in the Wall Street Journal, right? Did the economy grow? And our GNP's growing like 7%. The reason it's growing is because of the payments back into the country. So gross domestic product is just what we make here. But what you make here, plus the fact that we earn overseas and bring the money back, that's good growth. I don't know if it's 7% for sure, but let's just use that number. And then you have the growth of the money supply. Now, this is tricky because the simplest thing to do, look at M2, money supply number 2. And I'm going to show it to you. And it grows. It's growing. Now, what's funny is it didn't grow for a while, or it grew just a little. But all of a sudden with the $1 trillion stimulus payments, that causes it to grow. But the thing most people don't realize is that the Federal Reserve System is pumping cash into the economy, roughly $1.5 trillion a year. I want you to think about that for a minute. So our economy is about 20 billion. The growth rate 7%. So that's 1.4 billion. So the U.S. government is producing 1.4 billion in growth of money supply just through purchases of bonds, purchases of government bonds. So when we run a deficit, we borrow. Then we go ahead and we buy back the bonds. So we're creating money, and we also buy back some mortgage-backed securities. And I think we might even do a little bit of commercial paper. But so it's 120. It's so funny because the numbers tie. It's if GNP growth is 7% on, these are all rough numbers, but they're good enough for government here, on 20 billion, that's 1.4 billion, right? And that's GNP. And then you have the growth in the money supply, which just the one thing I can think of is 120 billion, trillion. I'm so sorry. This is trillion. Sometimes I get my numbers wrong. So it's 1 trillion gross domestic product in the United States. And then you have 120 billion per month in bond purchases times 12 equals, oh boy, 1.44 trillion. So the feds have decided to balance it out. Totally cool. I'm with that. But there's a reason why they're doing that. And so let's go one level deeper. So growth in gross national product, right, has been affected by coronavirus. And so maybe what they're thinking is, and also supply chain shocks and things like that. So what they're thinking is, let's just kind of goose it up, right? Maybe we can grow GNP by making money more available. Now that's like hearsay and that's just ideas, right? But let's talk about, so it's hard to change gross national product growth. It's hard to get somebody to take their wallet out and write a check for something or pay with a credit card or debit card. It's hard to get a real person to build a factory or start a company or invest in capital goods or buy a house, build a house, whatever. Something that wasn't there before. But now money supply is interesting. So money supply is driven, and there's a whole bunch of math behind this, but I just want you to get the concept, by the velocity of money. So what's the velocity of money? The velocity of money is how often like a single dollar bill travels and gets spent. So if everyone took all of their dollar bills, all their money, I don't care if it's Bitcoin, it doesn't matter, all your money, and they put it in a bank account and they said you're not allowed to lend it out. It's locked. It's under a mattress, right? It's in a wallet. It's just not moving. Then the money supply is just the availability of the currency. And that's easy. But what happens in real life is there's a velocity of money. And the last time I looked, it was like 20 years ago, whatever, 10 years ago, the velocity of money was 5. So if the government produced $1, then somebody borrowed that dollar. As an example, I follow companies that borrow money. And they borrow the money and they put it in a bank account before they spend it. So they borrow it, they deposit it. By the way, you and I do that. We maybe have an account with one of the top banks, U.S. Bank, Wells Fargo, Citibank, Bank of America, J.P. Morgan Chase. Those top 5 banks control something like half of your half of the money that the regular people in the United States have, or savings. And so we deposit it in a bank, and then J.P. Morgan Chase lends it out. So they lend it to a company, maybe even on a credit card. So people buy, people spend, people put money in the bank, they then deposit, they then make a loan, they then put the money in the bank, they make a loan, and then sometimes you spend money on something and they've already spent the money. So I had a client write us a check, right? I went out and bought equipment. The check hadn't even cleared yet. It didn't matter. Bought the equipment. Now Dell took that money and they probably put it in the bank, which got lent out again. And so velocity of money, boom, boom, boom. And as long as we're borrowing more and spending more and growing, the velocity of money goes up. And the idea is that you can lend and re-lend the same dollar multiple times. So, but what happens when velocity shrinks? And I believe velocity has shrunk right now. So the companies that I follow, I own stocks in 2 companies. Everything else is indexes, right? And one of them is working their tail off to deleverage. So they're not borrowing. They're actually paying it back. And the bank has to take that money and pay it back. They lose the deposit. It unwinds. So what's happening is leverage is being unwound in our economy. So that may not be the case everywhere, but then I have a second company I invested in. They owe a ton of money, and they just decided to refinance it all, make it simple, and then forced themselves to pay back the money every quarter. So you're talking about deleverage, and I know that people have been doing this. So if you're not going to the mall, you're not buying a car, you're not buying a house, you're not spending your money, you're not going to restaurants, you're not driving, you put the money in the bank. Well, the odds are you're earning maybe 1%, maybe 0.5%, but your credit cards are worth 20% interest. So you're probably paying off your credit card debt, paying off your student loan debt, paying off your mortgage, paying off. So the velocity of money shrinks. Now, the government knows that. The Fed knows that. This happened during the 2008 housing crisis. So we had really good experience. So what really happens is that while everyone is feeling good, hey, $1 trillion in a stimulus, right? Big money's slowing down. So as money slows down, there's less of it. Velocity of money. And it's important because what I think has been happening is the Federal Reserve System has been trying to make up for the losses in velocity of money. So now you have to think about tomorrow, because inflation yesterday, great, but that doesn't matter, right? We make decisions on inflation expectations tomorrow. So what will happen tomorrow? So people are worried because if people start taking money out of the stock market, as an example, if they get nervous and they stop spending, right? It's hard to imagine them people stopping spending more, but let's just say, then velocity will go down. If the economy continues to open up, if houses get purchased, if factories get reopened, if office buildings get reopened or built, the velocity of money will increase, and that will save the day. So it's really up to you. Will the economy grow? Will the velocity of money grow? Because every 1% of growth in gross national product allows the money supply to grow 1%. And that's a lot of money. So if we can get the economy to grow 5% more than it was growing now, then if the money supply grows by 5%, we break even, there's no inflation. So that's important. So then the next thing is what's going to happen with money supply, right? So we talked about GDP growth and the money supply growth. So the Fed is pumping $1.44 trillion a year into our economy, cash. So let's say they stop tomorrow. Then if gross national product continues to grow by 7%, but money does not grow, then we're kind of in trouble, because the money is like the oil in your car engine. It lubricates. And so if there's not enough money, then you can't make the transactions required to grow your economy. Like if I want to borrow money to buy my next computer, or better yet, I want to buy an office building because people are buying consulting. If I can't borrow the money, if the bank doesn't have it because the deposits are gone, you're going to actually impact gross national product growth in the negative without money. And so it's possible that they will continue to make bond purchases because they're thinking they need to do it to keep up with the growth in GNP. So that's the theory. Okay. Now let's talk about the things that we're reading about. And I have TweetDeck up because inflation. There's so many posts. 10 seconds ago, 9 seconds, 15, 25. I'm on Twitter now. And, long-term cyclical pattern that's repeated for 3,000 years. Annual CPI rise of 6%. The Fed, Powell, the Fed head, said inflation's under control. Cryptocurrency is a hedge against inflation. Right now they're talking about gas prices. $100 plywood. I mean, it's great. There's lots of posts about inflation, right? And so, in fact, the big one here, right, is the gas pipeline. So hackers came and Colonial Pipeline, they shut it down. They didn't want to pay, so they got shut down. By the way, for my wife, Diana, I love you to the moon and back. The best thing that ever happened to me, by the way. Oh my gosh. So, but I don't think that supply shocks like gas pipeline, or maybe not enough people to cut trees down in the woods, right, is inflation. To me, inflation is based on overall money because it raises all prices. So let's keep looking here. This is important. So gross national product growth. Massachusetts reached 75% of adults with at least one COVID dose. And yesterday joined 6 other states, Israel, England, Scotland, and Northern Ireland, for having its first day with 0 COVID deaths. Zero. So if we're not dying of COVID, we're all going back to work. We're all going to try to make up for all that lost time. And that's your economy growing. That's gross national product growth. It's true. We are seeing the underpinnings of economic growth. So now, this is zero hedge. By the way, I love Tyler Durden. The real Tyler Durden. So here's a nice cartoon for you if you like cartoons. Here's inflation, grab an Uncle Sam, right? So the Fed's calling it transitory. They found somebody from a company called Principal Global Investors. I think they were at my public library last week. Not sure. Markets are expecting a rise in inflation. Why? Because GNP's shrinking? Or because money supply is growing? Or because money supply has been growing more than GNP? You don't hear people talking about it that way. I'd like to hear people talking about it that way. I think that's the way you got to talk about it. So, are there one-time shocks in our supply chain? Absolutely yes. No doubt about it. And by the way, we're looking at a possible war in the Middle East. And to be honest, I'm not going to pick sides here, although I definitely have a side. But the Palestinians fired rockets into Jerusalem, right? The holiest city, other than maybe Mecca and maybe New York City, right? Those are like your three holiest cities in the world. And then I love Chicago, so please don't ever do anything to Chicago. But bomb Jerusalem with missiles, right? And then you're gonna have a war, or you're gonna have a big fight at least, right? And so, inflation is trending on Twitter. So this is like a really big topic. So we could have wars, we could have famines, we could have gas pipelines shut down, we could have people posting about $100 plywood. That's great. It's all out there, right? But the truth is, if the economy starts to grow, we need more money, not less money. The question is how much, right? And that's what the Federal Reserve Bank does for us, right? Do one-time supply shocks cause inflation? No. No, however, there's always a caveat. If supply chain shocks lower GNP, that creates inflation. If it lowers what I'll call systematic GNP growth, meaning we lost 1% of our population, now the GNP can't grow as fast, or we shut down all our pipelines, so now we don't have energy that we need. We raised income taxes, corporate and personal income taxes, which makes people less likely to earn. We raise the cost of work. Right? Those are all things that people worry about. And I've talked in the past about the challenges of raising corporate tax rates. I have not talked about the cost of raising transfer payments to people, because honestly, most people I know, they really need the money right now. This is not a question of extravagance in our welfare programs. I think the welfare programs really help people. And so, but at the end of the day, the only way that a supply shock is going to cause inflation is if it, over a long period of time, creates a systematic lowering of GNP potential. Now, inflation is a monetary policy issue. It's a money flow issue, but it's not a real economy issue. So what happens is you decide to run your business. I run a consulting business, right? So I don't stop running a consulting business because cheese costs 5 cents more in the grocery store. I don't even stop because gasoline is more expensive. I just charge a little more. I have to, right? If I have to drive to a client and instead of it being $2 a gallon, it's $4 a gallon, and that's going to cost me extra $20 a week or a month, I say to my client, you know what? I come see you every week. It's costing me $20 more a month. Do you mind if I pass along the cost to you? And the client may say no, thank you. But probably they're going to say, well, can you show me some receipts? Absolutely. I'm happy to have you pay actual cost. And then when the price goes back down again, I won't charge you more. I'll charge you to follow the cost. Great. So it's a money flow issue into assets, right? So where's the money flowing? So now I want to talk about why inflation is bad. Why is it a big deal, right? Let's go even bigger here on the screen. I want you to see this, right? So inflation reduces the value of things. So you saved your whole life, okay? I had an uncle on my ex-wife's side who died, and I was the executor of the estate. He had money in savings bonds. He earned maybe 2%. But you know, when inflation is 8%, he lost money every year. He didn't care. He was an old guy. He didn't know any better. He bought bonds. Yeah, he probably bought them. He was an elevator operator, and he bought them during the war, and he kept buying more bonds. Loved bonds, right? So you put money in your savings account, and you earn 0.5% interest, but inflation's 3%. It's like somebody's reaching their hand into your savings account every year and stealing the difference between inflation and the interest rate you're getting paid. Anything calculated in currency, right? Your house loses value when inflation goes up. Antiques, stocks lose value because there's an alternative out there. Cash definitely loses value. You put cash under your mattress, you're just losing the purchasing power one for one. Gold loses value, silver, Bitcoin loses value, and bonds lose value with inflation. So you're going to say, oh no, Bitcoin is great. It's a hedge against inflation. No. What happens is the price goes up for many of these things, for all of these things, in order to just break even. So your house, good example, right? If prices go up 3%, your house is going to go up 3%. If it's in a nice neighborhood and it's just like the rest of the country, right? And if inflation goes up 30%, your house is going to go up 30% because you're going to require the same real payment for your house. There's a market price, Zillow. Go to Zillow or go to your real estate agent and there you go, right? Gold has a market price, silver, Bitcoin, bonds. Bonds trade every day, every hour, right? Cash, there's no market pricing mechanism. A dollar's a dollar. It's worth more, it's worth less. A euro, your CD, your bank account. So there's no market pricing mechanism for things. And those are the things where you actually lose the value. And so, you know, that's why it's important. So let's go through some of the stuff. So just inflation notes. Let's save them up. So let's go through some of the things that I had kept. So here, inflation fears are dogging Wall Street at a time when the U.S. rebound is picking up speed. Wall Street pinned in red with investors spooked by inflation. So why is that? That's because when you have inflation, and you can, let's say, over time, it takes a while, but over time, you can earn 8% in the bank. Well, of course, I don't want to struggle to earn 5% in stocks when I can guaranteed FDIC insured earn 8% in a CD in the bank. Done. All the money comes out of the stock market. That's what people are worried about. They're worried about having an alternative place to put money. And it really does hurt the stock market. I mean, this is a big deal, right? People worry because inflation makes the alternative use of that money better. Let's go back. Gas prices. Love it. A whole article on gas prices from Reuters. Days from opening from the cyber attack, right? Prices are up. They're saying that the so funny. It's one pipeline. Nope, there's actually nothing in here about prices. I'm sorry. Let's see. Where's the good stuff? Well, this was interesting. So how do you stop inflation? you stop the bond buying. So Bank of England slows the pace of its bond buying. I heard Bank of Canada has stopped the pace of its bond buying. And our Federal Reserve Bank presidents, which are not the chairman, but each of them, has been talking about what it would take for them to reduce their bond buying. So the minute you reduce the amount of bonds that you're buying, you will actually reduce the growth in the money supply, which directly reduces inflation right away. I mean, if you're buying bonds every month, every week, every day, and you stop buying them, you've just reduced inflation that day. You don't even have to tell anyone. You just do it. Right? We had some productivity versus labor costs that I thought was important because this is actually very important for you. Zoom it up. Hourly output per worker. The economic output per worker went up 5.4% last quarter on an annual basis. Data for the fourth quarter fell at 3.8%. So up 5.4, down 3.8, productivity. So if you want wages to increase, so compared to the first quarter of last year, productivity rose at 4%. So if you want wages to increase, I think I read somewhere wages are up like 3%. So what's interesting is if wages are up 3% over the year and productivity is up 4% over the year, then actually the workers are losing 1% of the value they create, and the companies gain that 1%. So the balance of power is moving to the companies. That means if you're raising wages by 3%, it's disinflationary. It is de-inflationary. It is not inflation at all. There is a solid, rock solid reason for wages to be growing by 4% over the past year. Because productivity grew 4.1% over the past year. Unit labor costs fell, but they did grow in the fourth quarter, 5.6%. But here's the most important number: unit labor costs increased at a 1.6% rate from a year ago. So if I go back to my sticky, let's pop it up here. Let's capture those numbers. It's actually really important numbers because this is actually showing you that there's deflation in wages. Deflation, non-inflation, negative inflation. In the U.S. over the past 12 months. So what you have, I'm going to blow this up, make it nice and big for you. No one's talking to you about this stuff. You feel it, by the way. Who got a raise last year? Who got a nice big fat raise? I know our family didn't. I don't know anyone who got a big fat raise. I know people who were just getting paid out of mercy payments, right? Because they didn't want to throw them out of work. I know a company that I follow, right, been cutting costs. They held off on some wage cuts, on some labor cuts, because they were worried. So here we go. So 2020 productivity. So this is 1 year. Q1 to Q1. Up 4.1%. 2020 wages. Unit cost of labor. And I'm pretty sure people aren't working more. They're probably working less. Well, that's up 1.6%. So, nominal, or what I'll call inflationary wages, are down 2.5%. So if I'm a worker, I want inflation right now because, or at least I want the appearance of inflation. Give me a raise, boss. Give me a raise. Give me a raise. So the good news is hourly compensation rose at 5% last quarter. And output was up 5.4% last quarter. So there's no inflation here, guys. None. You can explain all the growth in wages with productivity. In fact, the companies are taking more and more of the fruits of labor. If anything, you should see more aggressive unionization. I'm expecting to hear Karl Marx coming out of the woodwork. So, this is not in time when labor is getting a lot of benefit. So what else? Indian COVID. Oh, shipping. This one's interesting. I think everyone should be thinking about this as well. Maersk expects tailwind to last amid high demand for containers. Okay, so high demand of shipping containers from China to the U.S. Imports into North America from Asia rose 40%. I just want to put this down for a minute. There was 40%. And the company's not going to buy any more ships. This is just Maersk, but Maersk is big. Now, why is this relevant now? Because growth in containers is expected to be up 5 to 7%, let's say, for next year. But last year, because of COVID, it fell. It contracted. It was negative 1.8% last year. So containers, transportation, are a good proxy for economic activity. And that's where it is. So there's just a few other things I could talk to you about. The Fed chair, right? Charles Evans, who I've met, good guy, pretty level-headed. He weighs in on easing. The Boston weighs in on easing. I read Dallas weighing in on easing. Another Fed president. And basically what they're saying is it's too early. It's too early to ease. It's too early to reduce monetary growth. And so there's so many. Let's see. More jobs, more spending. Inflation is running rampant. So this was interesting. So mentions of inflation are up. So I love it, by the way. I'm going to tell you a quick story from my that's awful. Let's do it right. Doesn't matter. I'm going to show it to you from here. All right. Mentions of inflation have exploded 800% year on year. So it's not that inflation is up 800%. It's that people are talking about it. Transportation, materials, and labor. So what's interesting is you just saw labor not going up, not over the year, although possibly now in the second quarter, now that productivity's up like 5, 6, 7%, I would expect to see labor up 5, 6, 7%. But people don't see the productivity. They see profits and they think they're doing a great job. They don't want to pay the people. And so if they're saying inflation is driven by labor, we've already explained that. People are being more productive. They've been working from home. They learned how to do it. Do you know, I don't commute. I saved 2.5 hours a day. I used to go in the city. I used to at the park. I wanted to get lunch. I'd take an hour. I'd go walk around and have lunch. Now I want to have lunch. Grab a cup of tea. I grab a sandwich. It's about 7 minutes. And then I'm back at my desk. Sometimes I eat at my desk, right? So talk about transportation. It's true. Gasoline prices. Not enough trucks, by the way. I've been reading. Not enough truck drivers. Because with COVID, the truck drivers need to get licensed. They need a special license, a commercial driver's license. And they need training. And so the training program shut down because people are afraid to get COVID. And then there's materials outlays. And so I think some of the same issues, right? Are we sending in 10,000 people into the woods to cut down trees? I mean, maybe now. For a long time, everyone stayed home. And so we started using up the materials. Mines might have shut down, right? Oil, gas. As long as the stuff's automated, it's fine. But manual, like lumber is all manual. So I'm not surprised, right? So I love it. So far, inflation has not crushed the bottom line of companies. Well, you know why it hasn't crushed them? Because productivity's up. Right? World economies are roaring back and demand is strong for goods and services. So what I worry about here, right? There's a confusion now. This is my thought for you folks out there. If you hear that the economy is growing and that causes inflation, I want you to stop and think about what I said. Inflation is a mathematical equation. Growth in gross national product, so it's our productivity in our country plus what we produce in other countries and bring home. So it's our national productivity minus the growth rate of spendable money, basically, of a nice broad M2 money supply, right? And so if I hear that the economy's growing like 1% more than it did last week or last year, then I could grow my currency another 1% and not worry about it and not be inflationary. If, on the other hand, I'm hearing that the economy's slowing down, that's different. So I read somewhere that job postings are up 8%. Where's that? I'm never going to find anything. There's so many things to talk about. Let's see if I have the article. I might have it. Yeah. There's a record number of jobs open. There's 8.1 million jobs available in the United States. Holy moly. If I wanted a job, I could go back to one of the big tech firms probably, right? Most people I know, that's a lot of jobs. And the economy's balancing out. I know people are hiring, and the word on the street is they're having trouble finding the skills. So you could look at this data and look at it two ways. One is companies are planning to invest in more people, more factories, more businesses, more ways to make money, and they need human beings to do the job. I think that's great. That shows GDP is going to grow, and that puts inflation on the back burner. On the other hand, if you continue to hear that they can't hire because of a systematic degradation of the labor quality in the United States, that could cause inflation. And then always look to the other side, right? Our Federal Reserve is pretty transparent with what they do. And so there is a data element here that I have that I want to show you. All right. Money stock measures. So we're looking at currency and circulation. So you got M1, M2, currency and circulation, reserve balances, monetary base, M1 and M2. So this does not have percentage changes, but that's okay. So M2 in November of 2019 was 15.3. Whoa. It's now 19, it's actually 20. So, but over a year, it was 19.4. That's a lot. It's actually a lot. So if we're growing M2, let's just round it from 15 to 20. That's up a third. That's 33%. If gross national product has grown by 7%, and money supply has grown by 33%, we did it. We created inflation. And this thing is accelerated. It's 19.9. It's 20 in March. In February, it was 19.6. So we created 400 billion. We created another 150 billion in January. 120 billion in December. This is money we created in M2. And so it just keeps going. We created 260 in November, $1 billion. We created 290 in October. So we are creating a tremendous amount of M2. And so there it is. There it is. That's why everyone's worried about inflation. It's in the M2 numbers. Let's look at the M1 numbers. So M1, holy cannoli, Batman. M1, we'll have to read the definition, is up from 4 trillion, these are trillions, to almost 19 trillion. So before May of 2020, M1 it also included currency outside the United States and vaults and treasury and banks and stuff like that, demand deposits, and other checkable deposits. And so beginning now, it's currency outside the U.S. Treasury, Federal Reserve banks, and the vaults, demand deposits. I need to blow this up. This is what everyone's worried about. I probably should have started with this. Less cash items in deposit, other liquid deposits, CDs, savings deposits. So what's happened is people have just put their money in the bank. There's more cash. There's more cash. There's more deposits. It's deleveraging, right? But now you see that there's money to be spent. There's cash. What's interesting is M2. So what is M2? Before 2020, it is savings deposits, small denomination time deposits. I guess that is your IRA, your KEO, your CDs. Retail money market funds. Still bank accounts. Still bank accounts. So tons of money has been accumulating in bank accounts. Look at that. Your monetary base grew from 3.3 trillion to 5.8 trillion. That is about 75% growth. So yeah, I guess you can seasonally adjust it all you want, M1 and M2, but there's a ton of money floating around out there. So there you have it. Yes. We have inflation. All right. We have it. So this is the thing to check. Now the question is, everyone can read this chart. I mean, it only took me 43 minutes to get here, right? And say, oh, the Federal Reserve Bank has been doing things and the stimulus payments and all that. We've been creating, it looks like, up to $200-300 billion a month in money. So, okay. It's a lot of money, actually. I'm shocked, by the way, just so you know, I'm shocked. Because you don't see it in labor prices. You really don't see it in regular goods and services. You see it in energy prices. You see it in some commodities. But I thought that was due to the dollar being weak or some transitory issues. You've got a pretty significant easing that's been done to the money supply. And so, there it is. They can fix this, by the way. Stroke of a pen, tip of a hat, change reserve requirements, do things. So, all right. Well, what else can I show you? I can show you that prices have risen. Let's find it. Yeah, there's always a good one. There's BLS.gov, Consumer Price Index. I shared this a while ago. Over the last 12 months, all items, they're up 4.2% over 12 months. Food is up 2.4%. Energy is up 25%. So what I would have said was the prices are rising because the energy price is rising because of oil and gas. And that's it. And all this talk of renewable energy, what's been happening is we're making energy more expensive. And so by making it harder to get energy sources that we're used to using, things like coal, things like maybe like nuclear, right? Now we're forced to buy our energy, right? Oil and gas, and we're forced to feel guilty about it. So you drive down the road, you see a lot of windmills. You know what? Windmills aren't going to cut it. Let's be honest. I got to take my car out. I need gasoline. I want to run a factory. I need electricity. That electricity has to come from a power plant. That power plant can't fail me. So I need coal backups. I need nuclear. Here at the house, we're an all-electric house, right? So you can switch over to natural gas, maybe save a few bucks. But this is it. This is the story of inflation right now, right? Now, I'm hearing that rent is going up. The rent is too darn high. The guy ran for mayor on that. I love it. That's fine. You're going to see different things going up. By the way, you look at stock market, I think you're going to be surprised. Let's take a look at the S&P 500. By the way, I love the S&P 500. We'll go full screen. We're going to see if stock prices are up. We're going to look over a year. Get rid of the drawings. That's from a previous video. Let's take a look at it from a year, 1 day. So, yeah, it was at like 28.70, and it's now at 40.80. So the market's up. Stock market's up. It's true. We can add QQQ, which is your tech. We can add IWM, which is the Russells, which is small caps. I'm going to make small caps in pink because they're cute. You can see small caps have gone through the roof, right? The S&P 500 is up 44%. The tech is up 47%. Small caps are up 72%. So yeah, stock markets have gone up. Where do you put $200 billion or $300 billion a month? You could put it in the bank. That's fine. You're probably just going to stick it in a mutual fund. Put it in the stock market. Let it go to work for you. And so much money has gone in. Look at that. And it's not even like there's a peak. If you look at the volumes on the bottom, there's little peaks like March 18th and January 27, and not really. It's just, it's starting to taper off now, I think, because money supply growth must be tapering now. But for a while, money just kept pouring in. And so people talk about inflation as being bad for the stock market, but actually, before anyone knows it's inflationary. It drives up asset values. There's money chasing stuff. It chases houses. It chases commodities. There's people buying silver bars and stacking them up in their basement. Silver and gold. There's a whole thing now on Reddit. People are buying stocks, right? And so they're doing it because they want that asset, right? They feel like the money is getting freer, cheaper, easier. Money's easy, and I want to buy things. Once people wake up to the fact that there's inflation, now we're in trouble. Let's go back to the chart. Where's that chart? Well, here's velocity of money. Look at that. Look at the velocity of money. Guys, it's insane. Look at the velocity of money since 2Q. It's gone from 1.4, 1.5, 1.45 to 1.5, down to 1.1, 1.123. Guys, the velocity of money is in the toilet. What are we doing? Right? Go make a loan. Borrow the money. Put the money in the bank account. Let someone else borrow it. No, but this is the thing, right? So your velocity of money is down. The Fed is petrified. If they stop printing money, buying bonds and putting money in the economy, and this velocity keeps falling, there's not enough money to fund the recovery. And so there's a couple of stories here that are important to tell. So if your velocity of money is dropped, right, then this really isn't inflation, right? So you've got a velocity of money thing. You've got cash being produced. Cash, 2 to 300 billion a month, 1/3 growth. I mean, the M1, which is this currency, is up like 300% in a year. My God, that feels inflationary, right? The economy's growing like 7%. The money supply is growing, right? Way more than 7%. But there it is. There's your velocity of money. So as money moves slower, less money to go around. So I'm going to leave you with one last thing, right? So I was looking up, what is the definition of inflation? Just, regular old definition of inflation. Let's see if I can find it. I'm going to find it. I'm sorry. It's here somewhere. Ooh, inflation formula. There's some pretty charts, but that's not what I'm looking for. Can't believe the velocity's down that much. Come on, where's my definition? Yeah, where's my formula? Come on now. Let's talk about the velocity of money. So sorry it's this hard to find the definition of inflation. Here it is. All right. It's a little bit backwards, but basically prices, number of transactions, divided by the total amount of money in circulation is velocity. So as velocity falls by 1/3, from 1.4 to 1.1, if you want prices and you want the amount of transactions to stay the same, then you have to increase the money supply by 3 times. This is why the Fed was so worried, right? And if you move these things around again, you keep prices over here. You have money. You have the amount of money in circulation times velocity divided by the number of transactions equals prices. And so it's money supply times velocity, and you got to keep those things in balance. And so there's your story. The story is the money supply has jacked up, way above trend line. This is a 1-year number from Trading Economics, and you see the trend line. We were under it in October. We're over it in March. I bet you we're over it in April. It's going up. Money supply is going up, right? But velocity is going down. And so there's your story. So I don't think we have evil inflation. I think what we have is we have a Federal Reserve that is working really hard to balance those things. And so I'll just leave you with this thought, right? There's not a bad actor out there. There's a velocity of money that has dropped from 1.4 and change to 1.1. You have a money in circulation that's going up $200-300 billion a month, sometimes 100, sometimes more. We have shocks to the system, right, which are actually potentially reducing the number of transactions we have. No gas on the East Coast, no shopping, right? COVID, no shopping. And so prices are what they are, right? And most of the inflation you've seen is on the energy side. I have seen some real estate inflation as well, which is probably not in the CPI. The cost of a house goes up, right? But on the other hand, other things are going down. I bought upgrades. I bought a brand new server. I paid about half. It's not true. Maybe with all the bells and whistles. But I got 4 times more server for about the same money 5 years ago. And so certain things are going up, certain things are going down. My oil changes, they haven't gone up, things like that. So, all right. Good luck out in the markets. The inflation question to me is still open. There's not inflation, systematic inflation. There is a Federal Reserve that is trying to battle drops in the velocity of money. And the minute the velocity of money picks up, they've got to start pulling back the reins. And that's the conversation I want to hear from our Federal Reserve Bank. Thank you so much. Appreciate your time. Bye-bye now.